Say if you're raising on a deal in DFW, you're going to touch on the submarket, but you don't have to sell Dallas. Any people anywhere in the US or in the world, they're going to know Dallas for the most part. You get outside of Texas, most people don't even know where Abilene is.
Yeah.
And so we spent a good time of going through on our webinar, Abilene's here. These are the major economic drivers there. This is why we like it. This is the diversity of the economy there. There's not as much being built there now. So we have very few deliveries coming on, so less competition for new deliveries, and really putting time in to educate on the area.
Tim is one of the most authentic and genuine people I've ever met.
I sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome, everyone, to today's Hero Capital Raising Show. I'm your host, Tim Mai, and today I have a very special guest on the line with us, Mr. Nic Espanet. Nic was a former physical therapist turned real estate syndicator. He began his multifamily syndication career as a passive investor, like a lot of us did. That was back in 2016. And in 2018, he closed his first deal as a lead syndicator, asset manager. Have since passively invest as well as actively invest in over 3,000 doors. You've gone full-time during the COVID years. So super excited to interview Nic today. He specialized in deal acquisition, capital raising, asset management. Have raised over $23 million already. So let's give Nic a big welcome, y'all. Woohoo!
Thanks, Tim.
Yeah, thank you. So Nic, share with us, what got you into this world of real estate syndications? How did you learn about it? What had you made your very first investment and then decided to go full time?
First off, Happy New Year to everyone. And it's, great time of year to be getting started. But I started originally just looking for something different to do in my retirement. At the time, I was working as a physical therapist, had all my retirement in the stock market. And when I would sit down to read and research what to do with it, my eyes would just glaze over, and I'm like, this, it doesn't make sense. I don't enjoy it. It's not fun. Started looking at stuff in the single family world, but I either luckily or unluckily had a little bit of paralysis analysis where I just researched way too much, and then came across some multifamily mentorship programs, a couple of different ones, and went and attended those. I'm like, this doesn't seem that much more unrealistic than that much more difficult to do than the single family. And so joined initially thinking I was just going to do passive investment and continue working in the therapy world. Did a couple of passive investments and did start out with my IRA money, since I could not, I knew I wouldn't be able to invest those in my own deal, but that's just where I wanted to start also. But after a couple of those, I'm like, this is not that, it's not impossible. It's something I think I can do. So really started applying myself at that point. That was probably, late 16, early 17, and decided I wanted to try to do my own syndication. Took about a year, as I really started focusing, making offers, and was able to close my first deal in the first part of 2018. But mostly just started looking for something different to do with my retirement, and knew I enjoyed real estate, enjoyed the single family stuff, but actually never bought a single family investment property. I've bought homes that my wife and I've lived in, but never actually bought an investment, which my first real estate deal was a 100-unit property.
That's awesome. And, I know before we started the show here, you were sharing with me your story of how you decided to go full-time in this industry. So let's have you, go into that. And because I know that a lot of people are probably having challenges with their properties right now, in similar situation to what you went through. And so let's we can if you can share with us a bit about that.
At that time, we had had 4 properties, and they're in Abilene, Texas, which is about 2 hours west of where I live. And one of them was having some challenges. We were in the process. It was COVID, and we were replacing our management company, so our occupancy had dropped. They were not getting the make readies done. Main thing was, it's so important keeping consistent staff. They could not keep staff hired at that one property. The property management company we're replacing. So my wife and I visited, and I was transitioning out. I was doing contract therapy. We decided, look, if this property goes under, we're fully bought into real estate. We don't want to lose a property. We wouldn't ever want to lose a property, but if we let this one go, we're going to be done. So that's when we said, the numbers don't quite make sense for me to retire from my therapy job, but we need to get out there. And so I was spending 3 to 5 days a week for about 8 weeks in Abilene. I took over a big part of the property management on that property. It's a 124 unit property. So I could go out there and, and make a difference. I walked every unit, took very good notes and set up an Excel and ranked the units from easiest to make ready to, really difficult. And I said, some of these just need to be clean. Let's get them cleaned and get them rented. And so I took over doing that. And that's when I kind of was forced, or, it moved me into that full-time real estate at that time. And at that point we had four properties under, that we were had syndicated, and haven't looked back from that. But it's, it was a time where we needed to go out there. I actually trashed a unit by myself. I had have a F-150 truck. I filled the truck bed up 4 times with stuff and hauled it to the dumpster. And the sofa king bed were still in there. I couldn't get those out by myself, but I cleaned that because the unit was in decent shape. It just had just clothes and stuff everywhere in it. And I actually went and borrowed a snow shovel and a big a wheelbarrow from somebody to help get stuff to clean stuff out of the unit. So that's when I started full time. I still have my license. I'll keep it. I don't know. It's not much to keep it going, but who knows if we'll ever need it again, but hopefully not, but I'll keep it fresh, keep it alive at least.
Right. Yes. A lot of people don't realize that to be a successful asset manager, you really do have to be that kind of hands-on, like what Nic was just sharing. A lot of times, like I've seen many deals, and the most common, whenever a deal goes in trouble, the most common reason is because of the lack of hands-on, boots on the ground, asset management aspect of it, being on top of the property managers, or like what Nic just did, even took over the property management. Yeah, that's really awesome. So now, are you still actively managing any properties? Yeah.
I have 9 deals that I'm part of now, and I'm involved in 7 asset management on 7 of them. And I check KPIs. I'm blessed to have a really good property management company, but we still keep an eye on it because it could go down. It's hard to turn the ship around once it gets going the wrong way, but have a handful of KPIs that we're checking at least weekly, if not 2 or 3 times a week on some of them, to watch and see if those start moving the wrong direction. We can do, get involved with them. We just closed the deal December 20th. I'll be involved with that, early on. But, my deals out in Abilene that we've had good management for almost 3 years now. We do a call twice. We do the 2nd and 4th Tuesday of the month, and we get through 4 properties in under an hour. So that it's, once they're stabilized and going well, it's not a ton of time. Now I do open up our software and just look at our occupancy, look at delinquency. That's a big thing that you want to see if that's ticking up, see where that's going. But I do stay involved. I tried to back off, but didn't, with the person we put in charge, didn't do a good job, and I had to hop back in. So my wife and I are looking at potentially hiring an asset manager to oversee it, where we are in charge of them, but we still have quite a bit of involvement in all of our deals.
Gotcha. Okay. And are you guys still outsourcing the property management side, or have you taken that in-house?
We are still using third party just because my deals are scattered. We have almost 900 units in Abilene, 462 in Houston, and about 280 in DFW. So they're too scattered to bring under management. I've talked to a couple of peers that have, and I used to think it was around 1,000 units, but these guys have started their own business. They said, wait till you have 2,000 in proximity of each other. And some people do it with less, but it's, talking to them also, they're like, you're getting another job. You're going to be much more involved with people as you come in and start your own property management company. So you need to be willing to take on that.
Gotcha. And then I assume that you're pretty on top of the property manager's side. How often do you meet with them?
Most of our properties, it's once a week. And we've got a couple that if they have challenges, we may go to twice a week. Even my properties out in Abilene, where we have a call every 2 weeks, I probably text with the regional once or twice a week. If there's any issues, she calls me, and we'll go through things, but we have a formal call every 2 weeks. And then we just closed a property out there in Abilene. That one we'll do weekly, at least for probably 9 months to a year.
I see. And do you visit the properties weekly or bi-weekly? No?
That one that we just took over will go every 1 to 2 weeks. The others I try to go out once a month. I try to go to Abilene once a month, Houston once a month, and then the DFW properties I'm 30 minutes and 45, 50 minutes from. I'll try to drop in there. One of them's about a year. We're every 2 to 4 weeks on that.
Gotcha. Okay, yeah. I was just finished raising for one of the deals here in Houston this past week. Crazy time to raise at the end of the year. It was a lot of fun. But that property got in trouble because they outsourced the property management company, and the property I guess the staff of that property managers, they were given bonuses and incentivized on filling the units. However, they were not incentivized on filling the units with good tenants. So they filled the units with whatever tenants they can find, and produce like fake income, and didn't do reference, all kinds of craziness. Anyways, that
property that I went out when I quit doing therapy, we had the same problem. And our regional caught them, figured it out, asked for an in-person lease audit. Well, the girl never showed up again. 2 weeks later, the CDC implemented the eviction moratorium across the country. So we had I think 9 residents that were not qualified, and we couldn't get them out for almost a year. They ran up $8,000 to $10,000 in delinquency each. And so during the eviction moratorium, we had our hands were tied on being able to move them out. So we now really, if we're doing some type of bonus structure for a lease, we don't want to pay it out till they've paid at least 2 months of their lease. Ideal 1, but if we can get it to 2 to make sure they're getting qualified. And our regional caught that. And in a normal year, if we wouldn't have had the CDC moratorium, we've been able to evict them within a month. But it really affected it was almost 100K, 80 to 100K in delinquency by the time we got all those out on a C-class property. It was a big hit.
Gotcha. Yeah, the COVID definitely had an interesting, put in an interesting experience for all of us, for sure. Because of COVID is how I got out of the single family home space completely. I was doing a lot of fix and flips, and dealing with the evictions, and dealing with the city for permits and stuff was crazy. And so that's when I got out and got into this business. And let's talk about capital raising, Nic. With you coming from the healthcare space as a physical therapist, have you raised much money from the that healthcare industry?
I have not. I've just started focusing on that. I've been part of a group that we are able to raise capital fairly well within our real estate group.
Oh,
and
cool.
then also, you will usually bring in 1 or 2 others to help, depending on the current the atmosphere was. It's more difficult now, so you need a little more help. But I'm in the process of rebranding from Thrive Multifamily to Flex Equity Group, and so that's part of it. Is Flex is kind of like therapy, and I want to start attending more healthcare, either medical and health provider events. The physical therapy world, we can bring in small investors. It's not a high net worth group target, but getting some of the outlying physicians and dental practices is an area that my wife and I are starting to really focus and lean in towards, in addition to the real estate. People that, because right now, as you probably, deals are not selling like they were. When deals were selling in 2 or 3 years, a lot of money was coming back in the system. It's easier to raise. Now you're having to hold deals for a longer time period, so there's less capital within that real estate world to raise for the next deal.
Right. You mentioned about being in part of a group, and you were able to raise money from the group. So was it a lot of the money was raised within the members of the group, or did you also take on a lot of, co-GPs to help you raise?
Initially, the bulk, probably 3/4 was raised within the group, but in the
Mm,
last couple of years, it's probably closer to a quarter or half within that group, and then outside sources from there.
I see. I see. And so what are your, are you still actively sourcing deals right now?
Not this minute because we closed December 20th, so I'm kind of taking a pause. I think if I got another deal now, my wife might kill me just because it was hectic. But if an opportunity came up right now, I would do it. I'm looking smaller. I think the days of raising double digit, teens or 20 are difficult. So I don't really know that I'd rather do something smaller with 2 or 3 people instead of having to bring in a team of 10 or like a large number of people to raise capital. So I'd want to keep something more in the $3 to $5 million range now. I think would be of the raise side. And so yes, I'm definitely looking. Would definitely look at another deal, go after. I think there's opportunity coming up, and there's even a non-distressed deals. The deal we closed, we assumed a Freddie Mac loan at a 4.22 interest rate with
Nice.
over 10 years left on the term. So there's some attractive assumable opportunities also.
That's really good. And what class do you normally go after or currently go after?
I'm a B, A minus B. We started out in C. I want to stay in 80s or newer unless it's something that's really unique. We are experiencing 70 stuff is not bad, but we're seeing just your below the line cost or taking between sewer lines and some leaks in the properties can be a challenge. So or just making sure you're underwriting much higher not replacement reserves, R&M, repairs and maintenance stuff, just because it's a 50-plus-year-old building, that likely still has the original sewer lines, water lines in it that are going to start giving out. Even some of the air conditioners. The deal we closed was built in 82, and it had 53 original ACs in it, and we budgeted to replace all of them, but that stuff, it's things start breaking, and we definitely are making sure everything's painted. We want to get all that stuff set up, but it's still it's the stuff underground that's expensive to replace, sewer lines and water lines that in these
Right.
50-year-old buildings.
I see. If you look at, across all of the passive investors that have invested in your deals and profile them as an avatar, what are some of the major type of people they are?
And mostly professional. I think medical, just that we've met through real estate investing, engineer, IT, a lot of IT professionals that just because they have they have money that they've earned, been blessed to earn a lot through their careers. But I think it's mostly engineers, medical, and IT.
I see. Okay. And out of those, just curious, any one particular type that you found easier to raise money from, or any other type that's harder? Like maybe easier because they have more money, they ask less questions, versus the
I
others.
think your engineer types at times can get way too analytical, kind of have the analysis paralysis for they want every single box to be checked perfect. Can be more challenging, but once the great thing is getting the repeat investors, even on deals like the one I spoke on earlier that was challenging. We tried to be above and beyond communicating and transparent what was going on in the property. Here are the challenges we're having. Here are the things we're doing to make those right. And several of those people have invested in other deals, even on that deal that was challenging. And so I think just communicating, but the probably and they're not extremely difficult, but the engineers are just going to ask more questions. They want to have that detail just from their background. That I don't know if that's their personalities got them in the engineering world, or being an engineer got them to have that more detailed mindset.
You mentioned about the deal that you guys just closed on here at the end of the year. How much was that raise?
It was a 9.5.
9.5
between
million.
9.5.
And how long did it take you guys to raise that?
About 2 months.
Okay.
We've started August. Yeah, right. Just a little past 2 months. And
Gotcha.
I brought in some other guys I knew that had a lot of experience. Because I knew, 3 years ago I would have tried to do it basically on my own, but I brought in somebody I thought could bring in more than half of the money.
I see. Okay. What did you find worked well in that race? And then what didn't work so well?
I think that it came back to making individual contacts. I called and or texted, not all, but especially the ones that had clicked. I started out with the lower hanging fruit, people that have clicked on links in the emails, registered for the webinar, things like that. They've showed a little bit of interest, and I just get a list. And I actually would spend the evenings at, try not to start too early in the morning in case people are on the West Coast. It's hard to know with everybody moving in different phone numbers, but start at 10 o'clock in the morning calling. And if they don't answer, send a text so they know it's me that's calling, and we'll call back. And just, it takes time, but just having that individual touch point, I think really helped with a lot of people. Because what I always try to tell others is, even though this is the most important thing I have going, or we have going right now, raising money, everybody else has life going on, and we're about 500th on their list. And so we've got to get back to the top of their list to remind them. And they may have every intention of investing, but they've got kids and family and work and all this other stuff that's pulling their attention. So just getting, trying to find that fine line where you're not calling them every day and annoying the heck out of them, but every 3 to 5 days, giving them a little touch point of touching base, more than just a mass email that they're getting.
Right. So, okay. So from your email CIMs, I'm gonna kind of break it down here. From your CIM, you're tracking who clicked on. Did you have more than one links in that email, or was it just the link to the webinar video?
Webinar video, and then a link. We started probably 2 or 3 deals back doing a landing page instead of that way we have less stuff in the email that's going out. It's less likely to get flagged into spam.
I like that.
And you can, your landing page, you can edit. Once you send an email out, it's out there and permanent, and you can't edit anything. But with a landing page, you can come in and add new information, edit it if you need to. And so we started doing, so a link for the webinar registration, and then a link for the landing page. And then within the landing page, we'll have the slide deck, many more links in there that we can track. Clicks within that.
I like that a lot. I like that a lot. So, okay. So shorter email with a link to go to a landing page. Landing page has more information. And on that landing page is where they can register for the webinar, or is the webinar a separate
once the
page?
webinar is done, we do a recording. And I've started setting up chapters on the recording. It's through in YouTube. It's not really, it just keeps going. You can jump to the start of the analysis, the introductions. And so that way they don't have to watch through the whole. I mean, we'll put the whole webinar on there, but also beside it have it broken down in 10, 15 chapters where they can start at different points within the webinar.
Gotcha.
Having to speed through it or try to jump through it.
Right. So it's still just one video, but has markers for different chapters. Is that correct?
Correct. You can go into YouTube and put start here, and it's a link that will start at 7 minutes and 32 seconds or wherever point you want. You call that analysis section. And all it's really doing is it is still the whole video, but it's just starting there.
I see. Okay. That makes sense. I like that. So yeah, so you track who clicked, who watched the webinar, and then you do personal outreach to those. Correct. And then you have a bigger list of people who opened your email. Did you do anything with that bigger list?
Once I get through the ones that have done more clicking, then I'll start calling through. And then we had a soft commit list early on, and that's on I just prioritize people that have expressed interest. Or I have a handful of people that have verbally told me they were interested in different points, and I'll definitely follow back up with them. It's and then a lot of time it's just following up with people that have started their paperwork within the portal, and trying to get them to continue all the way through until they've wired the funds.
I like that.
So, lots of phone calls. I probably could go back and pull how many times I dialed my phone, and I have through my CRM a different phone number and then a personal. And so I will also try to call on my personal number and send a text, just so they they may already have that number in their contacts also, so they recognize the number that's calling them.
Right. Yeah, I like that. I even went through the step. So I emailed everyone in my CIM, and then I exclude everyone who opened the email in the CIM, and I emailed them through my Google Workspace. So that way, if they didn't open from the CIM because of email deliverability issues or whatever, they would open in the Google Workspace email. And I use a tool called YAMM, yet another mail merge. It works similar to like Gmass, if any of you guys are familiar with that. And yeah, I was able to get a lot more opens between those two. And so yeah, and with raising money toward the end of the year, did you notice that there was a big demand for people that wanted higher depreciation?
We did. There's a lot of people that said, "Are you sure you're going to close by the end of the year?" And we gave a lot of reassurance for that. And then there was a bit of a lull around Thanksgiving, and then right before Christmas, it really ticked up again. I think people started realizing that what hasn't been a ton of deal transactions this year, and we were one of the ones we were confident that we're going to close, especially once we got to one like we have the money to close. We will close this year, and we could raise. We ended up having all the funds, but we are very confident we're going to close this year. With once we're within a certain dollar amount, we knew we could close, and that's when we got a big push, a big secondary push after the lull of coming out of Thanksgiving, and within a couple of weeks after that, it really picked up.
Right. Did you guys? I know like some operators they like to advertise how much depreciation year 1, year 2. Some don't like to advertise that at all, especially if they haven't got started with their cost seg. How did you go about doing it? Did you advertise the depreciation amount or not? Or
we did. We had 2 quotes, and they both were fairly close, so we were confident with it. And it's in 2023 we were only able to pass 80% through. So with that calculation, we said this is how much depreciation you're going to get, and so we were 3% lower than they were estimating too. So we built a little cushion into it. So we did show the depreciation on our promotional stuff.
I see. Okay, yeah.
And we knew, because we engaged them right away. We've done it. We knew that as long as we close, even December 31st, we're good. We made sure with our, because I've closed another deal on December 30th, and we were still able to do depreciation. That was in 21, but I double checked with our tax person. I'm like, we are good if we close and have her to test our the actual survey done in 24. We're still good, and we got reassurance that was good, and so we were okay marketing it.
Gotcha. That's great. Yeah. And can you share how much that depreciation was?
We on this deal, it was about 60% of your total investment. Because we were assuming loan rate, it's a lower leverage deal, so it helped because we were I take that back. It wasn't as low. We were about a 70% leverage. I said that backwards. A little higher leverage than a lot of other deals that are coming out. We had a deal that closed in 22, and we were closer to 50% leverage, so our depreciation was less because we had to raise more money, because your depreciation dollar amount is the same. If you raise more capital, your percent that you're giving back to investors is smaller.
Right.
And having a little better leverage on this assumption, we were able to give more pass more depreciation. And as the GPs, we did not take a GP cut of the depreciation. And
gotcha.
Sometimes we have done that in the past, but we wanted to make sure the is more attractive for the LPs. So we passed 100% through to the LPs.
That's good. Yeah, one of the deals I was raising for had a 220% depreciation. That was crazy. And the way that they structured, I thought it was just brilliant way of structuring. So it was a reposition deal. It wasn't not a new acquisition. And they had 2 classes of shares, and the total raise was 16.2 million. 16.2 million. So they did 1 class of shares for 5.5 million, and then the other class of share for the remaining 11-ish million.
So
Yeah. And so they focus all of their raise in the deal is still raising now, but what they did was they focused their raise in 2023 for the $5.5 million shares, and gave all of the depreciation, including the one, not just the GP depreciation, but also the $11 million LP depreciation over to this $5.5 million depreciation. And so they were able to concentrate on just this $5.5 million, and we were able to raise it real fast. Yeah, like I raised, yeah, so I started raising for it about a week before New Year's. So within a week, just me and a couple of my team members raised over $1 million just like in that short week.
That's
you know,
nice.
after Christmas and before New Year. It was kind of crazy. Even New Year's Eve, I was, Sunday, New Year's Eve, I was still raising. And yeah, so I thought that was such a brilliant way of doing that. And now, now that that $5.5 million has been, fully raised, now they're switching over to raising for the other 11 million that has a higher pref. And so it allows the investors, if they want more depreciation, to put their money in the 5.5 million. If they want more cash flow and they didn't care as much about the depreciation, they can invest in the 11 million share. So that was I've never seen it worked out like that. And apparently a lot of CPA doesn't know that there's a way that you can depreciate more than 100% of what you invest. Are you familiar with that?
I haven't heard that
rule?
structure, but I've heard where private equity or pref will come in, and the pref cannot take the depreciation, so it passes over to the LPs, where you're getting that 200% depreciation for the common equity, for the cap on that side of the. No, that's especially as we're, in 2024, we're only able to give 60% of what the depreciation is with the way the law is going. So that'll become even more attractive, something like that, because we are, as these deals sell and we're not getting as much depreciation on the new purchases, there's going to be some, we'll work through it. There'll be some tax challenges, but I think maybe that's the solution, like you're talking about, to be able to not have to recapture all that without having more depreciation coming in on a future deal.
I'm learning completely brand new also is that, for the LP, I didn't know that, I guess the IRS has rules that they cannot depreciate more than 100% of what they invest. However, so that's the common knowledge. So like one of my investors, had me on the phone with her CPA, and her CPA is like, no, you can't, she can only, whatever she invests, that is the maximum, 100% of that is the maximum that she can depreciate. But then the CPA firm that did for the deal says, no, we have a way around that. So I'm still discovering how exactly that works behind the scene. If any of you guys know about that, well, let me know.
And that's one of the challenges, Tim, is having these great CPAs like yours that says you can do this, and then you talk to investors and their CPAs are like, no, that's impossible. It kind of, I don't know if you've heard Tom Millwright speak, but he talks about the tax code being massive. Most CPAs know this much, and he feels like they know this much. And it's just, we've gone through about 3 different CPAs and have one that we really like now. But the one I had when I started in real estate, they basically, when we talked about deductions, I can't believe we didn't stay with you much longer after. They said, you're just blessed to be able to make this much money. You can't. I was like, no, I don't want to pay any more than I have to. And so, we went into somebody that had a real estate experience. So definitely not all CPAs are created equally.
Right. Yes. And Corrigan Krause is the CPA firm that knows how to do that, in case you guys are wondering. Yeah, so what else? What else did you learn, about that raise? Like, what was challenging? What didn't work well for you guys in that race?
I think the mass emails are not as effective as they used to be.
Right.
One, because the deals are not turning over. You're not having just all that easy capital, but it's you have to actually, kind of pound the pavement, old school, dialing for dollars, if you want to call it that, but calling people individually and chatting with them and visiting with them and letting them know what's the opportunity. And it's it's a challenge. This deal is in a tertiary market. We do run into where some people like, I only invest in the Texas Triangle, and teaching them about this secondary market, tertiary market, which I actually like better now than some of my primary major markets, because we have the courts are more conservative and people are evicted in a timely manner. So we have very little delinquency. I looked at all the properties this morning, the 4 we have out there. The 5th one, we don't have our software up yet, but one had $0 in delinquency for December rent. The other 2 were less than 100, and one was at 1,000. And so that's out of 4 properties, 580 units. We had less than $1,300 in total delinquency.
Wow, that's awesome.
But educating people that you don't have the astronomical growth you might have in Dallas and Houston. It's just nice and steady.
Right.
But it's nice and steady, all the time. So that's, it's always been a challenge when we raise in a tertiary market, is educating people on the positives of that market.
Right. That's a really good point. And I want to circle back to that point as well. I want to first touch on what you said about, going beyond the mass email. Yes, you totally have to do that, because it's so limited. When you send out blast email, the amount of people that actually get to see your email and get to see your deal is a very small amount, because of email deliverability issues, because of people not reading their emails, or they didn't just receive your email, they received like 100 other emails that day. And so that's the reason why I do the mass email, I do the Google Workspace email, I do Messenger, I do WhatsApp, I do text, just like what you're talking about, Nick. And yes, you really do have to hit people all different channels, because you never know which channel is gonna hit them. They're like, hey, yeah, I didn't see your email, but I'm glad you text, or and so you really do have to hit all of those channels. Let's talk about the tertiary market. I have not raised for a deal in a tertiary market, and I've always been concerned about raising for those type of deals, because it's not as popular. So share with us some of your. You did what you have close to 1,000 doors in Abilene.
Yeah, almost 900.
900.
Town of it's 130,000 people, but one is that it's educating. Typically, say if you're raising on a deal in DFW, you're going to touch on the sub market, but you don't have to sell Dallas.
Right.
To most people anywhere in the U.S. or in the world, they're going to know Dallas for the most part. But you get outside of Texas, most people don't even know where Abilene is.
Yeah.
And so we spent a good time of going through on our webinar. This is, Abilene's here. These are the major economic drivers there. This is why we like it. This is the diversity of the economy there. There's not as much being built there now. So we have very few deliveries coming on. So less competition for new deliveries, and really putting time into to educate on the area. And it's a little easier now because I've owned there since 18. We show to our other properties where we've had what our rent growth is, what our lease trade outs are, we showed 2 years of delinquency of what the averages were for the properties. We have properties across the street. So that was it's easier now that we have properties there and can show what we've done.
That's good.
And so that's the biggest thing, is just you have to do a lot more education. If you go to Houston, Orlando, Phoenix, Charlotte, people are going to know those by name and know there's strong growth there. But you get into these tertiary markets, and we showed where Abilene, their unemployment was better over the last 10 years, is all but maybe 2 quarters is better than Texas, which Texas is better than the U.S. So you got that from, good sources too. That was from Texas Workforce Commission, and we cite all of our sources too, so people can follow up and double check them.
Right. And so outside of the education part of it, in terms of interest, do you find that, I guess, yeah, like when you're promoting the deal, do you see that there's a lot less interest?
I wouldn't
And
say a lot, but definitely less. I mean, when people say I don't invest outside of the Texas Triangle, or I only invest in major metros, and I try to spend some time educating on why that may not be the best thing, but in the end, we want someone to be comfortable investing. I don't want to talk somebody into investing.
right.
I want to give them facts and let them that they're comfortable with investing in that market.
Yeah, that's really good. Yeah, that's one of the things that I coming from the single family home space, I use this analogy in a single family home. We go after sellers that need to sell, not sellers that want to sell. It's and so same thing here when it comes to raising money for these syndication deals. I look for investors that need to invest, not the ones that want to invest. So that way there's no selling. It's like, hey, you need to invest, you need to deploy the money. I have this asset. And yeah, like you said, sell, like in your case, having to sell them or educate them on the market itself, because it's not a market that they're familiar with. But other than that education, you really do need to leave it up to them to make that decision for sure.
Definitely.
Yeah, that's awesome. What else? Anything else about this race that you want to share with us that I haven't asked?
Yeah, I think we've covered about it. I think it's just, also picking a team that you not only can raise the capital, but that you can work well with too. You don't want to, somebody that you have to communicate with on a regular basis and go through the deal with that one doesn't understand the deal, two can be difficult to work with. But I think one of the, that's one of the biggest takeaways. Work with people that you get along with that can, also complement your business skills and the team skills, but also personality wise come along well. But this one was just following up because we did one end of last year that was pretty challenging too. And it's just being consistent, getting up every day, calling people and following up with them and setting up a routine of checking with the people and having, being able to make those personal contacts, because like you said, it's just the mass emails are not, even mass text, which is gone. It reaches more people, but I think you still need to call and follow up with them, actually chat with somebody, take them to coffee or lunch or dinner or something, get contacts with them.
Right. Yes. All right. Let's talk about some of the tools that you use in your business. You mentioned about using landing page. What are some of the tools that you're using in your business?
So I started with Smart Syndicator. That's to help. My wife does a lot of work with that, sending out our mass communications, and then also a portal. We use Cashflow Portal, which is helpful. I mean, when I started doing this, we were doing the syndications, all the documents on PDFs, email and stuff, saying you got to sign page 13, 27, 25, and then you get it back. They scan it, send it back. They've missed the signature. But being able to do the portals where you can come in and you can track who started their paperwork, finished their paperwork, who you sent funding instructions to, and then who have ultimately funded. That makes it so much easier. And my first investment, I didn't raise money like this. I remember guys physically carrying blank copies of their PPM and their operating agreement around in folders at the, getting people to actually sign them and drive them over to their house and have them sign. By the time I started, we were scanning and able to send them through emails, but but having the syndication portal of some sort, and then having a CRM where you can send stuff and send the mass text, and and being able to track that stuff is important. But then I think once you close, also having systems and different. My wife has set up some things where we track. She enters it now. We're working on hiring somebody to do it, but where we have the we went back and entered this for all of our properties. We can see our NOI, I mean our net rental income, other income, total income, expenses, NOI, and occupancy compared to our pro forma and our property management budget, going back from time of takeover, and then we can see trends within that, and we should send a little 3-month picture into each one out to our investors, and each just a screenshot of that to investors on each newsletter, so they can kind of see where things are tracking. But having a system to where those things are being checked on a regular basis, and we're merging into ClickUp now. Still haven't got all the kinks worked out where we get reminders, either if there's things we want to check weekly, monthly, quarterly, and annually. But we're setting ClickUp where we get those reminders through an email or a notification to check them, and then even within the team, so we can start bringing in other people. We can see if they've done their task within ClickUp, but being able to track what's being tracked for you.
I see. So you were using Smart Syndicator, which is a go high level
Yes.
platform. So you are now no longer using high level as a CM?
We're using Go High Level. Before I used MailChimp.
Okay.
Up until the last deal, I've used MailChimp. It's been a little bit of growing pain with a Go High Level, growing pains.
Yeah.
Just because I used MailChimp for so long. But when we were able to get through a lot of it, and it'll be a lot easier next time. But that's also going to be, I started in this when you didn't have to do as much communicating with your potential investors, because just another deal sold, you raised money, you just kept going. Now I'm trying to be much better about keeping everybody warm, sending out monthly newsletters, just a little bit of information and the people that, like, a lot of your people within the real estate world that we're all doing this. They don't think those, but it's my outside people that I've met at other venues, family and friends that I want to keep up to date on what's going on, but trying to keep them warm. So it's not 9 months later, and they haven't heard from me in 9 months unless they're getting a newsletter. I want everybody getting a monthly, page or two worth of information that's coming out. And that's something I've struggled with and really working on with the Smart Syndicator to get a monthly newsletter out.
I see. Okay. So then you're just using ClickUp for project management then, it sounds like.
Correct.
Okay. I understand.
Well, we're very new. So my wife has taken a few classes on it. And so she's kind of spearheading that, but we're definitely trying to get that to where, because I've kept it in my head, I do everything and eventually get to where I've got, one, it's hard to pass it on to somebody else to take over those roles. And two, you're going to miss something. You get enough deals and you're trying to just do it by memory every time, you eventually miss something.
Gotcha. Okay. So here in 2024, what are your projections looking like? Are you, do you see that there will be a lot of opportunities? Are you planning to take advantage of as many opportunities as you can, or what's your outlook?
No, I think there definitely will be opportunities. We're coming to the year 3 of 2021 into early 2022. A lot of deals were built. Most deals, I don't know the number, but I would suspect 80% or more were bought on bridge loans, either floating or most of those are on 3-year terms, and those are going to be coming due, starting this spring and into next year. And people are going to need to sell. If they, at the time they were getting 80% leverage on deals, now it's 65%. Are these deals, if operations have done well, they've improved the value, but you're trying to get out of an 80% leverage loan to a 65%. It just may not be there. And it may be the best option, may be selling it to try to. And so I think those opportunities are going to be coming out. Plus there have been very few trades in the last year, especially the last half of 23. There's a lot of pent up capital that I think wants deals to come out, and as interest rates optimistically are coming down, there should be lots of opportunity as those deals start coming. back on the coming onto the market, and that capital starts coming out and loosening up as, you know, if we can start getting some better lending too, as rates are coming down.
Right. No, that's really good. For the folks that are listening, wants to connect with you, partner with you, invest with you, learn from you, where would you like to send them?
So I have a Calendly link, which is visitwithnick.com. I put it in the chat earlier, or my email is nick@flexequitygroup.com. So flexequitygroup.com. You can send me an email. We can connect. I'd love to chat with anybody. And I'll add my, you know, I'll add both those in there. Yeah, reach out. Let's set up a call. Let to tell you what we're doing and how I've gotten to this point. You know, going from 0 units to over 1,600 total units in about a 7.5 year period. Really in 5, because I've kind of piddled around the first year and a half.
Right. Oh, that's how it works sometimes. And it's give you an opportunity to build your foundation during that time. That's for sure. Okay, Nick, thank you so much for doing this interview with me today. Really appreciate you. Yeah, you've been a wealth amount of knowledge, and I love the fresh, up to date, what's happening in the marketplace, you know, what's happening around capital raising and asset management. Really appreciate you for being on our show today.
Tim, thanks for having me. I had a great time. It's good to meet everybody. I look forward to meeting up with some of you guys.
Okay.